Hello everyone, I'm Nikhil Mishra from Setu Capital. Today we'll be looking into a recycling company, which is a small cap company, and it has a global presence. So the stock which we'll be discussing is Gravita India. So it is an organized recycler of lead, aluminum, and plastic. First and foremost, let me give you a disclosure or disclaimer that yes, I do have investment in this company. None of the discussions which we do about this company is going to be an investment advice. You just take it as a education purpose only, and investment in securities are subject to market risk. Consult an investment advisor for all your stock related investments. So let's move ahead. So this company has been in the business since the past 30 years. What it does basically is that it collects scraps from original equipment manufacturers and lead or battery manufacturers, and then converts those scraps into the commodities like lead and etc., and also produces value added products which it further sells in the market. So this company started in Jaipur. Then after that, it started its operation in Sri Lanka, and then it went to the West and East Africa, and it has been adding specialities in its portfolio. Like they started with a lead recycling. Then after that, they diversified into plastic recycling in 2015, and then they started aluminum, and recently they have also started a rubber recycling plant. So what this company's strategy is that they will go at places where there is very little competition, and most of the players are from unorganized sector, which are trying to evade taxation and do not have efficient management. This company is also a bit working capital intensive and has inventory challenges. The reason being is that scraps or the raw material for them, which is the scraps, is located at different parts of the country. Let's say in India itself. So they do go over there, and after that they try to collect a scrap and bring it to their collection centers. From their collection center, they have to or recycling centers, they have to recycle and then produce. So the scrap collection and its subsequent um, validation takes a lot of time. For example, let's say this company brings scraps from US. So in order for the scrap to reach to its Jaipur plant, it takes around 1.5 to 2 months. So this is not an easy business, and it requires a lot of management bandwidth and capability to lead a project like this. So this company, as I said, has a global presence, mostly in areas where there is very less competition, and mostly the competitors are from unorganized players. So the headquarters are in India, and they do have the facilities in other parts of the world, mainly into Africa. 30% of the capital is employed in India, but the 75% of the profits of this company comes from the rest of the world. So this is the unique thing about this business. So these are the major customers of this company, mainly the battery manufacturers in India like Exide or Amar Raja, which produces Amaron, and other electrical wire manufacturers like KA Industries. Then you also have other automotive companies like Motherson Sumi, which whose name has changed to Samvardhan Motherson, Schneider Electric, Panasonic, Neil Kamal for its plastic recycling, etc. So what it does is, after after bringing the scraps, these scraps are converted into basic commodities, and then they do a value addition over there itself in their site, and they try to produce these lead sheet, lead bricks, red lead, plastic granules, PET flakes, etc. And these value added products have better margin, At present, the value-added products uh, it contributes around 42% to the top line of the business. Now, these value addition products do require some management capability and management know-how in the manufacturing process, and the company is trying to get more and more produce more and more value added product because it leads to improvement in margins of the company. So, looking forward to the coming demand, this company at present, if you look at the H1 FY23, it approximately a combination of all three, lead, aluminum, and plastic, it has around 212,000 megaton per annum. By FY26, means 3.5 years from now, it wants to more than double its capacity. So basically, the capacity addition will be at a rate of 25%. So, what makes this company sustain its profit margins and grow without diluting its profitability? First and foremost, this is a challenging business to operate. You need to have multiple collection centers, and the collection centers located across the India or across the world have to bring the products to a recycling plant, and over there, value addition products are made. Now, this also requires you to have multiple presence near the original equipment manufacturers. You also have to have import licenses. You need to have specialist knowledge. You need to have capability to develop customized products, and not all of it is present with unorganized players. You also need to get some licenses or tie-ups with various battery manufacturers and other chemical plants, and these all are time consuming and also capital consuming initiatives which not every company can go through. Now, many of you might think that why don't the original equipment manufacturer or the battery manufacturer itself does it? The reason for that is that the scale at which it operates, the recycling plants which it has, Gravita collects the products from multiple partners and brings it to a single location and then tries to recycle it. The operational efficiencies at lower base won't come, and the profitability won't be much high. That's why the OEMs just want to get rid of this scrap material, and they just want to focus on their main products of that is of technology and battery development rather than getting into the not so interesting task of converting scrap to other value added products and trying to extract the commodities which are present in them. So this company has a lot of tailwind. As per management estimates, the informal sector, which at present contributes around 35%, sorry, 65%, which will go down to 25%, from 65% to 25%. And the formal segment will move in the next 3.5 years, will move from 35% to 75%. Although this might be a bit optimistic assumption, but still the movement of the formalization is bound to happen, and with defined battery waste management rules and extended producer's responsibility, where the producer has to take care of whether of the lead being getting recycled. For example, let me give you an example of Germany. Like in India, we let's say if we have a battery, and if we don't like it and it has been used and has expired, then you can simply throw it away in your garbage bag and just they will take it. Nobody will ask. But let's say in Germany, if you do the same thing, you can even get means called to the police station, because over there are segregation rules that no, this is lead, so this becomes poisonous for the environment, and you cannot simply throw it. The same thing is going to happen in India, and with the environmental push, The Indian companies uh, will also have to follow more stricter recycling mechanisms. So Gravita has a pan-India presence, and it will be a major beneficiary of this informal to formal shift. So if we come to the financials of the company, you'll see that this company, in just 5 years, has has multiplied its revenue by 3.5 times, which brings us to around 28-29% of compounded annual growth rate. PAT margins have been quite volatile in the past and has recently moved a lot. The major reason was the fluctuation in the forex for this company, and this company has learned its lesson and has started hedging. So the contribution of revenues from overseas is around 36%. The profits contribution is 75%. 75%, as we can see in the right hand side. So financial summary is that 5 years CAGR revenue has grown at 26%, and profit have grown at around 34%. In the upcoming future, the company expects to generate a top line growth. Important thing is that this company only gives guidance in terms of volumes, because there is commodity prices which keep on fluctuating, and their revenues will also fluctuate, but they have a more or less guidance of around 20 to 25% top line growth of volume in volume terms, and the bottom line should grow at a faster rate as per their expectation, which makes this for the next upcoming 3 4 years, which makes this a very interesting and company which should be looked into quite details. All the newer projects which are coming up are targeted at more than 25% ROC. They should be having a payback period of around 3 years. Means whatever the company invests, it should be able to generate that much back within 3 years. It recently came out with its quarterly performance. The volume was around 17%. There was a bit of impact due to their Sri Lanka plant, which has got affected. But with the normalization in the Sri Lanka, they expect that plant to also start contributing. Revenue grew by 25%, PAT grew by 21%. They have been decreasing their debt. They have reduced their debt by around 89 crore rupees. So, what are the future prospect of this company? The future prospect of this company is, and the management is quite confident of generating 20 to 25% compounded annual growth rate over the next 3 4 years, and they are seeing having visibility with around 60,000 megaton plus healthy order book. They are doing capex, consistent capex in order to increase their manufacturing capability. So this company is relatively at a good juncture, is available, is not trading at a very high valuation as well. So this brings us to the end of this presentation. In case you guys did like my presentation, don't forget to like and subscribe. And if you wish to take any help of us for your any stock and mutual fund related services, do contact us. We'll be helping you in your wealth creation journey. And for more content on small and mid cap and micro cap companies, please do uh, press the bell icon and do subscribe. Don't forget to subscribe my channel. Thank you very much.